Hello, everybody. At this time, we are talking about long term financing. Long term financing represents those borrowings or loans which are offered for a period greater than 1 year. It can be done by issuing equity shares, debt financing, long term loans, bonds, or leases. A long term finance is taken either for big projects, company expansion, or financing. Usually, long term financing deals with huge amounts. The primary objective of long term finance is to either fund the projects that are strategically benefiting the company or help in the expansion of business operations of the company. This form of funding is generally applied to projects that would create coordination and cooperation within the organization in the subsequent years. And then we move to features of long-term financing. The first feature, extended repayment period. Long-term finance offers a repayment period of more than 1 year, which gives businesses enough time to generate returns on investment made using these funds. And then the second features, cost implications. The cost of long-term finance is normally lower than that of short-term loans because the risk perception by lenders is lower. However, equity financing may dilute ownership. Third, higher capital availability. Since long-term finance usually encompasses large-scale funding, businesses can raise a considerable amount of money to finance projects such as establishing new plants or venturing into new markets. And then fourth, diverse sources. Long-term financing sources include equity, retained earnings, loans, debentures, and venture capital. Each has flexibility depending on the needs of the company. And fifth, operational stability. Funds from long-term sources give stability to businesses so that they can concentrate on growth without worrying about short-term liabilities. And then we move to the key differences between short-term and long-term financing. The first about duration. The most evident difference between short and long-term financing is their duration. Short-term loans normally have a repayment duration of a year or less, though some might be as short as a few weeks or months. Long-term loans, on the other hand, have a longer repayment period, which might last several years. These loans are often used to cover larger investments such as real estate purchases, personal loans for travel, or business expansions. The prolonged term loans for reduces monthly payment, making it easier for borrowers to repay the loan over time. And then second, repayment structure. Short-term loans typically include a repayment schedule that includes frequent and smaller installments over the loan's shorter tenures. Long-term loans, on the other hand, typically have a more organized repayment schedule that includes larger, less frequent payments. The longer repayment period enables more reasonable monthly payments, making it possible for borrowers to repay larger loan amounts over time. And then third, interest rates. Short-term loans often have higher interest rates compared to longer-term loans. This higher interest rate reflects the perceived increased risk for lenders associated with shorter repayment periods. Lenders in turn charge higher interest rate to account for the faster turnaround and potential uncertainty in short-term financial obligations. Long-term loans often have more personal loan interest rates due to the extended repayment duration. The lower interest rates give borrowers with more favorable financing arrangement during the loan. Long-term financing consistency and predictability reduce the risk for lenders, allowing them to provide more competitive interest rates. And then we move to the primary reasons businesses need long-term financing. The first, to launch a business. Money is the foremost requirement for starting any business. You need finances to purchase resources, assets, and employees. You also need finances to cover the operational costs of a business. Finances for business loans are required before the business starts generating enough to pay for this cost. And then second, to expand a business. There comes a time when every business needs to take the next step and expand. And to grow a business in size, you need finances to bring in new technology and keep up with competitors. Buying new technology is relatively expensive, and businesses need to opt for long-term financing. This is because the cost to buy new tech will outweigh the revenue generated or saved by the business for a considerable amount of time. And then we move to sources of long-term financing. There are multiple sources of long-term financing. Some of the major sources are: the first, equity capital. This equity loan or capital represents the fund raised by a company using either initial public offering or a private investor. In both the public and private routes, the ownership of the company is diluted. However, the controlling power lies with the largest equity holder. There is no preferential right given to the equity holders, and they face the highest risk among all the shareholders. This is a zero-interest long-term financing, where the investors receive returns against their investment. Further, the equity holders receive a higher rate of return compared to the debt holders, as they face maximum risk during repayment of their invested fund. And then second, retained earnings. It is also termed as plowback profit. The source is beneficial one as no charges are included in it. The profits that the company earns are used for financing its debt, paying off investors, or offering stock options to its employees. Retained earnings can be used to expand the business after repaying all the dividends and interest charges. This is a safe option as no burden of debt relies on and no dilution of ownerships exists. I think it is enough. Thanks for watching.